This is a video on tax planning, particularly as a person nears retirement. It will be shown that the timing of reporting different types of income from year to year has a significant impact on taxes paid. It is brought to you by PolarisInvesting.com, a website for creating defensible stock valuations. Keep in mind that business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. Okay, to get started here, let's take a look at the personal income tax return. Most people viewing this video are quite familiar with this form. Here at the beginning of the form, information is gathered like name, address, and a list of dependents that is used later in the calculation of tax credits. And then it gets into the income section, primarily asking for your W-2 or wages that you've earned throughout the year, and then other kinds of income that might apply. Then it deducts from that income deductions, either standard or itemized, plus an additional amount for each exemption to arrive at taxable income. On the next page, tax owed is computed and credits are deducted from it to arrive at a total tax. And then, if prepayment on portions of the tax owed is deducted, and then the amount owed by the taxpayer, or the amount to be refunded by the Internal Revenue Service, is calculated. This form can be simplified into just three main sections: this blue section, green section, and purple section. The blue section identifies various income types, ranging from earned income, which is stated on a W-2 form you receive from your employer, interest from savings accounts, dividends from stock investments, before tax 401k IRA distributions, pension and annuity payments, Social Security payments, and capital gains from selling assets like stocks. Sum those together and you get total income. From total income, you go into the green section, which is adjusted gross income. It has things subtracted out like qualified student loan payments, personal pre-tax IRAs, contributions to health savings accounts, and possibly exclusions for portions of Social Security payments. From adjusted gross income, a standard deduction or itemized deductions are subtracted. Itemized deductions include things like state-home property taxes and home mortgage interest. You end up with taxable income. The third section is a tax is computed against the taxable income. Next, tax credits are subtracted. Tax credits are for things like low earned income, dependents, also known as child tax credit, child care, higher education, and renewable energy. And next, total tax is computed. It's important to keep in mind the purpose of the individual income tax statement, as stated up here, is to calculate federal tax owed by a taxpayer. In other words, money to help finance the federal government. Now, for those that are familiar with a company income statement, it's tempting to make comparisons between a company income statement and an individual income tax statement. But first off, you need to be clear that the purpose of the two are quite different. A company income statement is to inform investors of the company's operating efficiency for a specific period. Because it is operating efficiency, accrual accounting is used to align costs associated with the work to generate revenue with the revenue being reported in a period. Costs that are incurred in a period that are not associated with revenue being reported in that period are recorded as assets on the balance sheet, things like inventory, and then later are expensed in future income statements. When the revenue associated with those costs are reported. Let's quickly look at the company income statement. You have revenue, which is somewhat similar to this blue section over here. Subtract off cost of goods sold. These are expenses that are directly related to the revenue that's being reported. So it's somewhat like these deductions down here. Then you have further expenses on the company income statement that are called period expenses that cannot be associated directly with any specific revenues. So they are expensed as they occur. Then you have operating income, earnings before interest and taxes, and then subtract off any interest on debt. And over here, you do subtract off, if you're itemizing, home mortgage interest and things like that. So that's somewhat related. And then you have earnings before taxes, calculate the taxes, similar to having taxable income and calculating a tax over here in the individual income tax statement. Next, taxes are subtracted to arrive at net income. And that's reported out the investment community to represent the operating efficiency. But the reason that net income reflects operating efficiency for a specific period is because of accrual accounting. The revenue and the expenses that are reported against that revenue align with the work that was done to generate that revenue. So net income is meaningful to investors. Over here, the individual income statement, accrual accounting is not used. Instead, cash accounting is used. Just as individual receives wages, receives interest, it's reported as income. Any costs incurred during the year are deducted from that income. A tax is computed. And credits, like the child tax credit, are subtracted. And here on the personal income tax statement is built in as a reflection of the legislation around taxes and what the government's trying to achieve, along with raising funds to run the government. But it's also trying to incentivize people to behave a certain way by providing credits for children and child care, or allowing itemized deductions for state property taxes on a home and home mortgage interest. So it attempts to try to encourage people to consume by having children and buying houses. And there's many other kinds of credits and deductions, but there's incentives that are built into the tax code. So the company income statement over here and the individual income tax statement bear some resemblance, but they're not the same. And you notice over here you end up with a net income figure, but over here there's a total tax computed on the individual tax statement, but there's no line item that says net income, which would be income minus deductions minus taxes owed. Notice the tax form uses the terms income and deductions, not revenue and expenses. This is because personal taxes are based on cash accounting, not accrual accounting. In this context, net income has no meaning. With that background, now let's dive into how this total tax is actually computed. You can see here that the spreadsheet that we have that we're going to go through in more detail to see how the tax is computed. In this first year at age 55, we've got a total tax of $22,860. Well, using tax software named TurboTax, it is filled out to show the same total tax due, $22,860. On this TurboTax summary page, you see wage and salaries of $142,000. You got interest of $10,000, no pension, no Social Security, no traditional 401k distribution. We have a $30,000 of dividend and capital gains, which are grouped under the same heading of wealth distribution, since both are taxed at the same tax rate. You end up with total income. Next, adjusted gross income is computed. Then deductions are subtracted, resulting in a taxable income from which a tax is computed, net of credits of $22,860. Now, with TurboTax, it's a little difficult to find how it computes the total tax. If your tax return includes dividends or capital gains, TurboTax adds a form or a worksheet named Qualified Dividends and Capital Gains. If you open the worksheet, you'll see step-by-step instructions on how TurboTax computes the total tax. This worksheet is very useful to validate that taxes are being correctly computed. Now, further down this spreadsheet, we get into years where there is Social Security income. So to help understand how the actual Social Security payment is taxed, need to see another worksheet provided by TurboTax. But to do that, we need to have Social Security payment. So I'm just going to add briefly a Social Security payment. This causes TurboTax to include a Social Security worksheet. So now if I go to Forms, there's now a Social Security worksheet that you can go see the details of how TurboTax calculates the amount of that Social Security payment that's actually taxed. Next, we're going to use this summary view of the 1040 form to guide us through the spreadsheet's calculation of total tax. So start off here in the blue, have the same kinds of numbers here identified in blue in the spreadsheet. So you start off with your W-2 or your earned income, shows up here. Next you have interest, dividends. Dividends show up here in column J under wealth distribution because dividends and capital gains are currently both taxed at the same rate. Before tax distributions from a 401k or IRA are included along with pensions. Social Security, separate item here. Capital gain, as I mentioned, is under wealth distribution, and then you end up with a total income. Next is the green section, which adjusted gross income, deductions, and then taxable income. Now, adjusted gross income is a bit more involved. So now going to unhide some columns that show finer computational details. Columns L and M use the concept of provisional income. Provisional income is a temporary income that is computed to determine the amount of Social Security payments that are taxable. Now if we jump ahead to age 62 where there is a Social Security payment of $44,000, you can see here that only $37,400 is actually taxed. And to really understand how that amount is arrived at, you need to go look at the Social Security benefits worksheet. But it, like I said, it does depend on this provisional amount. And essentially the provisional income is everything that's in total income except for only half of the Social Security payment. Once the provisional income is determined, the amount of Social Security payments taxed is calculated. Looking here at the formula, you see there are several income thresholds used in determining the taxable portion. This is a clever approach that's taken here to provide people at a very low income level that rely mostly on Social Security to avoid having much of any of their Social Security payment taxed. But more income you have, the more of it's taxed. No more than 85% of the total Social Security payment is taxed for any taxpayer. Okay, once you have computed adjusted gross income, you subtract deductions, ending up with taxable income. We really should go to TurboTax and see the qualified dividends and capital gains tax worksheet to see the details. It's fairly involved, so there's some hidden columns here that we need to expose to see how this tax is computed. Before we go into the details of these columns that are now visible, look back at this summary of the income tax statement. You see here that line 15 says taxable income. And then it would seem logical that then you take the taxable income, and in order to calculate tax, you just run it against a tax table. But actually what happens is your taxable income that's stated as a single number on line 15 is split out based on how much of it was earned income and interest, pension, and Social Security versus how much of it was from wealth distribution. Wealth distribution, namely capital gains and dividends, is currently taxed at a 15% tax rate. The remaining ordinary income is what is run through a tax table, which is shown over here, and based on the amount that you earn, you get different tax rates applied. This first unhidden column is called the Taxable Income Stack and is yet another clever component of the tax code. Seems to be there to account for people who may be in between jobs or people approaching full retirement who are currently working part-time. It allows them to have capital gains and dividends up to the current limit of $83,350 and not be taxed on that. So if they're trying to get by in between jobs, they can live off their wealth without being taxed on it. But for those who have other sources of income, there is a limit to the amount of wealth that isn't taxed. So the taxable income stack is designed to compute how much income this wealth distribution sits on top of. And so the amount that's being shown here is saying that out of the taxable income that was computed, any wealth is going to stand on top of $123,300. Well, that's well above the $83,350 maximum. So you can see here that as far as the wealth that's excluded from taxing is zero. But you can see in later years, you have some wealth that is excluded from being taxed. So again, a clever way to bridge people in between jobs or approaching full retirement. So see how it's calculated, this taxable income stack. Simply take the taxable income, which again is after adjusted gross income and deductions, but the taxable income, and then subtract off the wealth distribution. And that's income stack that wealth is stacked on top of. And because it's well above the 83,350, there's no wealth that's excluded. But later years, you can see here that it's, example, stacked on top of 39,000 with a limit of 83,350. That leaves a difference of 44,350 of this distribution of wealth that's excluded from tax. So the difference between the wealth and what's excluded is actually taxed at 15%, and you can see here the calculation of the stack income using this tax rate, and then the wealth distribution portion that's actually taxed. In 2013, the Net Investment Income Tax, NIIT, was introduced to support the Affordable Care Act, also known as Obamacare. Now, any adjusted gross income that exceeds the NIIT income threshold that is attributable to wealth distribution, namely dividends, long or short-term capital gains, or interest, is taxed additionally at 3.8%. The following has been added to the original video to further explain NIIT. A key point is NIIT mainly applies to income from wealth distribution and interest. It does not include other income like Social Security benefits, 401k, IRA distributions, and pension payouts. The NIIT tax only potentially applies if your adjusted gross income exceeds the NIIT income threshold for a given year. It is calculated by applying the NIIT tax rate to the lesser of your adjusted gross income over the NIIT income threshold, or your wealth distribution plus interest. This has the net effect of additionally taxing any adjusted gross income that exceeds the NIIT income threshold that is attributable to wealth distribution or interest. Now back to the original video. Once the tax is computed and subtract off any tax credits to end up with the total tax. Since this video was originally recorded, there has been some changes to the spreadsheet. Now going to discuss those changes, moving from left to right in the spreadsheet. Used to have just one column labeled pension and included Social Security along with the pension value, but now break out Social Security as a separate column. Used to have just wealth, and now we have that broken out into its two components, namely dividends and capital gains. And then over here have added several columns that go into calculating the tax-free cash flow, namely any Roth 401k distribution, which is not taxed. The wealth distribution column clearly shows the amount of dividends and capital gains that are distributed and become part of this cash flow. The calculation uses the cost basis percentage indicated in cell AD1. The cost basis percentage is the percent of proceeds from selling long-term assets that are considered the cost basis. Using the values in column L, the total proceeds from selling long-term assets are calculated and then added to dividends from column K. Values in column AC are the annualized income-related monthly adjustment amount, also known as IRMAA, which are related to Medicare Part B. The amount of IRMAA owed is based on adjusted gross income in column P from 2 years previous. IRMAA AGI thresholds are shown in the table in the bottom right. IRMAA is essentially an additional income tax. IRMAA values are subtracted from tax-free cash flow in column AF. Also, there's a significant change here in cell E1 that lets you select the filing status, either joint or single. That impacts several income thresholds used in various calculations in the spreadsheet. Okay, now back to the original video. All right, now focusing just on the spreadsheet. Down here at the bottom is just some reminders, namely the tax table that's applied to that stacked portion of the split out of taxable income. Deductions, here's the standard deductions, married filing jointly. Here we have the capital gains tax rate, which is pretty much at 15%, but you do have this amount up to $83,350 that is excluded if you don't have any other income. The net investment income tax, which is that amount additional tax that was added to help pay for Affordable Care Act. You've also got this tax table here, which can be used. It calculates the same tax as the tax table over here. And then this other table we'll be talking about more later. It comes into play at age 73 and beyond. And you have a traditional 401k or IRA. There is a percent that must be distributed of the balance every year. And you'll see here that like these totals show up here because this scenario we're going to go through for an individual named John Smith, we're assuming he's nearing early retirement, but by the time he reaches 73, he's chose to delay any distributions. Therefore, starting at 73, he's having to take specific amounts of distributions. Okay, now we're going to shift to using the worksheet. Now that we've gone through how taxes are calculated, the worksheet is primarily intended for people interested in planning their finances over the last 25 to 30 years of their life. Up to this point, assume that earned income has been the primary source of income with some interest, a little bit of wealth distribution, but with a lot of things going on earlier in life, there are limited choices of income sources. For most people, their income consists primarily of earned income, and the income is consumed by living expenses such as raising children, education, cars, houses, and investing for the future. But as you get close to retirement and into retirement, it is advantageous to have clear financial goals to drive your retirement financial decisions. So here's a scenario of a John Smith who's nearing early retirement, so getting close to make that transition from being a high earned income earner over here to having other kinds of income. And you can see here that it is projected that John will take early retirement but still work part-time, but then shift to taking a pension and then taking Social Security early, and then those payments staying the same throughout retirement. By the way, all numbers are expressed in terms of today's dollars. Note there's a convention in the spreadsheet that any cells with a gray background accept user input. So for this spreadsheet, user would typically enter values in here and then up here as well, and also specify what year of birth, and then these years will adjust. There's like 27 years, so based on the year of birth, it'll start at the age entered in cell B5 and then go out for 27 years. It is important to have clear financial goals. Reasonable financial goals for a person approaching retirement are threefold. The primary goal is to live a desired lifestyle, which necessitates the need for cash flow. Secondary is to generate those cash flows in a cost-effective way, which means tax efficient. And then the third goal is to continue to grow wealth so that lifestyle can be sustained or pass on inheritance. The first step in achieving financial goals is to determine the required cash flow to sustain the desired lifestyle. In this example with John Smith, they cited roughly $150,000 a year as their goal. So over here in the income section, next have to identify what type of income to use in order to achieve that tax-free cash flow. For John, his cash flows are segmented into several periods: pre-retirement, early retirement, full retirement, a period in which Social Security payments must be taken, and a period in which there are required minimum distributions from traditional 401k or IRAs. So up here in pre-retirement, John is still working, so the majority of the targeted cash flow is coming from earned income. There is some interest in a little bit of wealth distribution, really through dividends, and then calculating the after tax is a little bit above the target, around $160,000. So this exercise is continued, and values are entered in all the way through pre-retirement phase. Then as John enters early retirement, forecast is he's going to work part-time, earn some earned income, have more interest income, start a small pension from a previous job, start taking Social Security early. Full retirement age is assumed to be 66, and then no distribution from a tax-deferred 401k or IRA, which can be done penalty-free, starting at 59.5, and then you can see here capital gains and dividends, resulting in a little bit less than the target during this period. And then entering full retirement, still working part-time, and really having the same mix of income. And then when Social Security has to be taken by, continue the same mix of income. And then starting at age 73, no longer working part-time, and now taking required minimum distributions from a traditional 401k or IRA. Now it is assumed this is a tax-deferred or before tax contribution, so when you pull it out, you are being taxed. Since this worksheet is used to compute tax owed, any distribution of a after-tax 401k or IRA, also known as a Roth, is not entered. But the way you would account for that in this approach of planning is you just reduce the cash flow amount that you're looking to generate by the amount that you're going to be withdrawing from your after-tax 401k or IRA. At this first pass through, have achieved the primary goal of generating cash flows for the desired lifestyle, but we also have two other goals, namely be tax efficient, hold the cost down, and continue to grow wealth. So tax efficiency is determined by this number here, and by itself it's hard to determine whether this mix of income is ideal. So what you have to try is different combinations of income types and see what it does to tax efficiency. Now it's advised not to use just the sum of tax payments because that does not account for the time value of money. So this is a present value of all those tax payments, and then up here you determine what the cost of money is, and the default is 6%. Also, as you're trying out different combinations of income, you want to see what the total impact is to your tax deferred 401k IRA. Same thing, it's not the accumulation of income sources, it's the present value of them. Again, the time value of money is now taken into account. So as these different income sources are tried, and you want to hit the $150,000 after-tax cash flow, but you're also looking at how tax efficient and how much cash flows are subsidized by wealth distribution. The more tax burden you incur, or the more you subsidize cash flows with wealth distribution, the less growth of wealth. Further on in retirement, a major component of income is distribution from a traditional 401k or IRA, and that is shown here. And the way that that's determined is that here in cell I1 you enter in the balance that you think you're going to have at the beginning of age 66. And in this scenario we're assuming that no distributions are taken until age 73. So that balance at age 66 is then advanced based on the time value of money to age 73, and then a required minimum distribution is calculated, and then that's what's entered in for these values. But this value here introduces a whole other discussion around 401k and IRA contributions throughout your working career. To facilitate that discussion, now switching over to this worksheet. A major decision regarding contributions is whether they are before or after tax. Now, the John Smith scenario we have been discussing assumes the person is far along in their career, now in pre-retirement, quickly approaching early retirement, thus have been making 401k IRA contributions for some time. I'm now going to have a separate discussion concentrating on contributions and distributions. This worksheet is divided up into a section dealing strictly with contributions, and then another section dealing with distributions, and then some detailed information behind the scenes dealing with tax liability. Well, to start off, we are going to concentrate on contributions. So we're going to hide off these other sections. Well, first you notice that there's a before tax contribution area on the worksheet, and then there's an after tax. So there's the traditional IRA 401k and then a Roth 401k or IRA. So it's comparing the two. And you'll notice here at the bottom, this $1,240,000 is the statement balance at the beginning of age 66, and that is what has been entered in over here. Now, looking at the statement balances for a before tax account versus an after tax account, an obvious thing to try is to take the before tax statement balance and multiply it by 1 minus the tax rate to get the after tax statement balance. But got to go back and restate what we're saying up here. Is this is actually employee before tax contributions, and this is employee after tax contributions. Even in a Roth 401k, there is a before tax component, and that is the employer match of a Roth 401k is typically before tax. Now, just to be clear, I'm going to temporarily unhide the columns that we previously hid. We'll be talking more about these hidden columns later, but it shows the tax-free balance of both before tax contributions and after tax, or Roth. And you can see here that the balances are exactly the same year to year, and then you end up with the exact tax-free balance for both kinds of accounts. So they are equivalent as long as the tax rate is the same at the time you make the contributions and when you take distributions. This equivalency can be seen here in these notes down here, where we show that for a traditional 401k compared to a Roth, what happens is there's a contribution made by an employee. Over time, that contribution grows, and then when the employee decides to distribute, there's a tax, and what the employee is left with is 1 minus the tax rate. And then you do some math on that, you can show that that's equivalent to the employee's original contribution growing for some time minus the tax liability growing for the same length of time. Now you compare that to an after-tax Roth. Employee makes a contribution, taxed right up front, and then that after-tax amount grows for some time. You do the math, and it's an equivalent to the employee making a contribution, that contribution growing, and then subtract out the tax liability that is also growing. So this clearly shows that they're equivalent as long as these tax rates at time of distribution and the tax rate at the time of contribution are the same. While we're here looking at the math, I want to point out a couple of other things. Is that if you look at the traditional 401k and this tax component that was deferred, what's happening here is the tax that you deferred continues to grow. So it's almost parasitic in nature. The key point is it grows within your account. So when you look at your statement balance, it looks pretty substantial, but actually it is not what it seems, because there is a large tax liability included in the amount. Now, comparing that to a Roth, where you paid the employee portion of tax up front, and that paid amount essentially is growing with the government, who you paid it to. Now, actually, the government doesn't invest, but spends the money to run the government. But for the sake of this comparison, it's if the government takes the money and it continues to grow, but outside your account. So here in the Roth statement balance, it's a lot lower number because it doesn't include the employee tax liability. Another thing I want to make sure you notice in regards to this math here, that the contribution withheld from your paycheck grows by the same amount in both a traditional 401k and a Roth 401k. When you eventually take a distribution, there is no capital gains tax for either the traditional 401k or the Roth. Another way to think about that is your cost basis is essentially stepped up. The tax that is paid is ordinary income on the contribution that was originally made. It's just a question of when it was collected. In a Roth, it's collected right up front when the contribution is made, but in a traditional 401k, it is collected on the back end when a distribution is taken, along with the growth associated with the tax liability. In a traditional 401k, the federal government benefits from your investment abilities because the tax liability that you owe grows with your total investment. Whereas with a Roth, that tax liability is collected right up front, and we all know that it's spent by the government, but you could think of it could also be invested by the government, thus grows on the government investment ability. With a traditional 401k, the tax liability eventually becomes due. And often when the distribution is taken, there's a significant tax due at that time. An alternate way to frame it, you essentially became contractually obligated for the tax liability long ago when you decided to use before tax contributions to fund your traditional 401k. It is suggested you take an altruistic view that this tax liability has been growing in your account for years, and now at distribution the federal government is benefiting from your investment abilities with little overhead to you. Looming tax liability associated with a traditional 401k is sometimes alluded to as the money illusion in the popular press. There are three main benefits for both a Roth IRA or 401k, namely the employer match, which can account for as much as 30% of the accumulation in your account. Also, as we discussed earlier, there is no capital gains tax, essentially tax favored. And that can add yet another 30% to the accumulation in your account. And then a third one that is often discussed in the popular press, namely a tax exposure hedge. Meaning that if you're doing a traditional 401k, when you go to distribute, if your tax rate is lower than when you made the contribution, then you benefit. But often that's not what happens in retirement. Your tax rate is equal or greater because of Social Security payments combined with other sources of income. In the Roth, same thing. You employee match, no capital gains. Now the tax exposure there is a little bit different. It's because you're doing after tax during the contribution. If you start off when you're young, when you're not making as much, you're likely in a substantially lower tax bracket compared to towards the end of your career. So the hedging of taxes is making those contributions month after month over 30, 40 years and with varying tax rates in between there. An idea to consider is you split between a Roth and a traditional and get that tax exposure hedge both when you're contributing, because half your fund is in a Roth IRA, but also you get the hedge when you distribute in the traditional 401k, because you distribute over time when you're retired. Now there is a fourth benefit that you sometimes read about relative to both Roth and traditional 401k. In the Roth, it's curtailing overspending as you're working month to month. That if you contribute with after-tax dollars, then when you look at your balance, you don't see quite a biggest balance. The hope is that it encourages you to maybe contribute even more, therefore limiting your spending as you're during your working years. Whereas the traditional 401k, it's on the back end when you're making distributions. Benefit is that maybe you won't distribute as much as early because you've got the big looming taxes. There is another significant advantage specific to the Roth 401k. Namely, you can accrue more wealth because the upfront taxes you pay are not considered part of the contribution. In a traditional 401k, contributions include future tax liabilities. In a Roth 401k, after-tax dollars contributions are made. Compared to a traditional 401k, you can essentially contribute an additional amount to a Roth 401k equal to the upfront taxes paid, which can be 10% or more than the equivalent tax-free traditional 401k contribution. Paying taxes and maximizing your contribution to a Roth 401k allows you to put more tax-free dollars into a tax-favored account each year than you can with a traditional 401k. This does further curtail your spending, so may not be practical, particularly for young workers needing money to pay off student debt and purchase their first home. Since Roth 401k contributions are after tax, the contributions, not earnings on those contributions, can be distributed anytime, tax-free. This may make it possible for you to contribute the maximum amount, knowing you can later pull some of the contributions out for future large purchases, like a first home. If you can start making the maximum Roth 401k contributions 30 years or more before retirement, you could possibly accrue an additional $500,000 or more by the time you retire than what you can with a traditional 401k. I want to go back to this curtail overspending. Let's don't forget what the genesis of the Roth 401k was. It was proposed by a senator from Delaware, William Roth, and it was a compromise to offset a decrease in capital gains tax. So it was conceived to increase the current tax revenue, to encourage people to use after-tax dollars. Now it's interesting, since the Roth 401k was available in 2006 and the Roth IRA was available way back in 1998, only 20% of 401ks and IRAs are actually Roths. This indicates that the money illusion associated with a traditional 401k is an alluring draw. Another thing to keep in mind regarding the traditional 401k IRA is taxes withheld from a distribution are considered paid throughout the tax year. This can be used to avoid underpayment penalty when a large gain is realized late in the year. Let's now focus in on the contributions here that John Smith has made during his working career and compare them if you'd done it as a before or after tax. So over here at age 22 to age 35, John didn't make any contributions. And unfortunately, that is all too common. These early years is where the biggest long-term impact is made. That with a lot of school debt, families being formed, just a lot of expenses early in adulthood. So here at age 36, John finally decided to start making contributions. And then you can see the employer match is typically about half of what an employee contributes. And then John here eventually, true of most people in their 50s, start getting real serious about retirement and start making pretty significant contributions. And then in John's case, he took early retirement at age 62. So he missed out on large contributions leading up to full retirement. We compare that to the Roth 401k after tax contributions. The employer contributions are before tax in both, so exactly the same. And then the total contribution is different between the two because of the after-tax nature of the employee contribution in the Roth 401k versus the traditional 401k. So then you end up with an account balance at age 66 that is quite different. As we discussed, they both have tax liabilities associated with them. So the actual after-tax amount that is represented by these amounts is exactly the same. Now, as we finish up this discussion on contributions, I want to stress the tax liability that's being accrued as contributions are being made. And then by age 66, there is a substantial tax liability for the traditional 401k, as you can see here. But only the employer-related accrual applies to the Roth 401k. So when these amounts are subtracted from the statement balances, you get the exact same amount. So it's important, particularly for the traditional 401k, to not forget about the tax liability that comes with that balance as you enter retirement and start to take distributions. Next, going to talk about distributions. Recall, John Smith is retiring early at age 62. The previous discussion on contributions carried the accumulation of contributions up to age 66, with 0 new contributions from 62 to 65. In this distribution discussion, the starting balances brought forward are as of age 62, and we pick up from there. The balance that we used on the previous worksheet is the beginning of age 66. We entered that number here, and then since John is postponing taking any distributions till age 73, we then moved that forward and ended up with this base amount at beginning of age 73. And then calculate the required minimum distribution. So over here, you can see that no distributions are taken till age 73, and then the first amount taken is the same amount. Anyway, here and here, it showed up here. So these numbers here are the same distribution numbers that we see here. Recall that we're assuming for John Smith that no distributions are taken until age 73. And when they are taken, we can see that the taxes paid are substantial. The tax rate's being assumed is 33%. Now this is the same tax rate that we assumed that applied when contributions were made. Over here on the after-tax Roth side, you can see that the taxes are considerably less. But you still have taxes because the employer portion of the Roth IRA is before tax. Here from age 62 to 72, where there are no distributions and we're past any contributions, you can see the traditional 401k balance is growing year to year because we're assuming a constant growth. And same thing over here on the if you had done a Roth, it's growing year to year. But what's quite different is the tax liability. Tax liabilities continue to grow year to year. You see there's quite a difference in the size of these tax liabilities. But the tax-free balances of the traditional 401k and Roth are equivalent year to year because the statement balances minus the outstanding tax liabilities result in the exact same tax-free balance. At the time of death, heirs inherit the outstanding balance of either the traditional 401k or the Roth. Along with those statement balances is the heirs also assume the outstanding tax liability associated with each type of account. So that's when we come down here and we assume that the heirs are at the same 33% tax rate, and then they have up to 10 years. Now there's no forced distribution. These distributions are just arbitrary, but no later than 10 years, heirs must take distributions for the entire outstanding balance. Now what you see here at the bottom is eventually the total tax-free after the 10 years, and you see that the tax-free balance is now equal in both traditional 401k and the Roth, and now the statement balance is reduced to zero. Also notice that the tax liabilities for both have been reduced to zero as well. As this example shows, the traditional 401k and the Roth 401k end up with equivalent after-tax balances. But it's assuming that the contribution tax rate and the distribution tax rates are the same. Now, if we were to change that assumption, either up here through the retirement years or post-death years and what the heirs tax rate is, we will see that these are no longer equal. To see that, let's go up here during the retirement years and change the tax rate. Now, changing the tax rate here has no impact because we're not making any distributions during these years. But this tax rate applies to years 73 through 81, so let's lower that tax rate to 25%. And now you can see that the traditional IRA ends up with a larger after-tax balance than the Roth IRA, as to be expected. The contributions were made at 33%, but then here we are distributing at a lower tax rate. Let's go the other way, and let's assume the tax rate goes up even higher than 33%, as high as 45%. Well, now the Roth looks advantageous to the traditional because contributions were taxed at 33%, and then we're avoiding paying taxes at the higher tax rate of 45%. We can do the same thing with the heirs tax rate as well and see how one would favor the other if any of the distributions are taxed at a different tax rate than contributions. Make note that once distributions are made, they are no longer in a tax-favored account. If reinvested, their cost basis is established at the time of distribution. Subsequent gains are eligible to be taxed. Worksheet assumes distributions are immediately reinvested and held to death of the owner or their heirs. At death, the cost basis of the reinvested distributions are stepped up, thus avoiding capital gains tax. Immediate reinvestment and stepped-up cost basis makes the timing and amount of distributions irrelevant. If distributions are not reinvested or not held to death, then the optimal tax strategy is to postpone distributions as long as possible in order to maximize their cost basis. One interesting strategy is to do a Roth conversion early on in retirement. A Roth does not have mandatory distributions. Well, we covered a lot of ground in this video, starting off with income taxes as someone nears retirement, some things that should be considered. the need to have well thought out financial goals to help guide the use of various types of income. So then went off and spent a fair amount of time talking about how traditional 401ks and Roth 401ks work. Now, for some final comments, I'm going to expand the notes over here and highlight the section here called Interesting Tidbits. You see a line here that says the 401k created staggering opportunities for poor financial decisions. As you can see in what we discussed in this video, there is a lot to be considered, requiring a disciplined approach. But many people lack the financial background to construct and apply this kind of rigorous framework, resulting in bad decisions. Some of the bad decisions we can see here is just about contributing, that on average the 401k balance is a mere 100k. There's only 1.5% balances greater than $1 million. Many baby boomers have less than $50,000 saved for retirement, and the average is $100,000. The other thing is distributions don't generate a guaranteed income stream. A person needs to carefully think about how that income stream is going to be generated, when, the tax ramifications. So hopefully this video helped think through those kinds of things. One last thing, if you're interested in getting the spreadsheet that was discussed in this video, go out to the PolarisInvesting.com website, take the Dropbox link, and from there open the Polaris website videos folder and go to Finance Topics and Spreadsheets and download the spreadsheet called Tax Planning General. Thanks for watching.